The Fed was just told to drop interest rates. That's right, direct pressure mounting from political circles, big banks, and a market that's getting increasingly impatient. But the question everyone's asking now is what does this actually mean for real estate? Is this the moment the housing market starts to shift again, or is it just more noise that won't change anything for buyers or sellers? Because let's be honest, if you've been waiting for the market to cool off, you've probably been waiting a while. Prices haven't crashed, rates haven't fallen the way some were expecting, and meanwhile, the economy is sending mixed signals. Stocks are volatile, inflation is stubborn, layoffs are creeping up, and yet homes are still going fast in a lot of places, even here in Arizona. So today we're breaking this down. We'll cover what's happening with the Fed, who's actually pressuring them to act, what it might mean for mortgage rates, and how this all ties back into the real estate market, both nationally and right here in the greater Phoenix area. Buckle up because there's more happening behind the scenes than most people realize. Now let's set the scene with what just happened. In late May, headlines started circulating that President Trump had summoned Federal Reserve Chair Jerome Powell and demanded rate cuts to support the economy going into 2025. According to the New York Post, this was part of an effort to combat slowing growth and rising recession fears, fears being echoed across the business world. And while the Fed has made it clear that they can operate independently, that kind of political pressure absolutely affects the conversation. At the same time, major investment firms like Wells Fargo and Goldman Sachs have been forecasting only modest rate cuts for the rest of 2025, nothing dramatic. Wells Fargo, for example, expects the average 30-year mortgage rate to hover around 6.9% this year, with a slight drop to 6.5% by 2026, according to Investopedia. But that's just the numbers. Let's talk about the psychology behind it all. Because whether you're buying, selling, or just watching from the sidelines, this isn't just about what the Fed does. It's about how people feel about what the Fed does and what do they expect to happen next. That's where real estate behavior actually starts to shift. So let's talk about where this really hits home mortgage rates. Right now, according to Freddie Mac, the average 30-year mortgage rate is sitting around 6.76%. That's a little down from the highs of 2023 and 2024, but still double what we saw during the pandemic. Even though the Fed doesn't directly control mortgage rates, the decisions they make on the federal funds rate heavily influence them, especially in terms of market confidence. Now, here's where it gets a little weird. As of today, inflation has cooled, just not enough. According to the Bureau of Labor Statistics, consumer prices rose 2.4% year over year in March 2025, which is down 2.8% in February, according to the BLS March 2025 CPI report. That's progress, but still not the Fed's 2% target. And then in April, a new round of tariffs hit certain imports, which economists say could push core inflation higher by the year end, according to Business Insider. So, the Fed's caught in a tricky balancing act. Do they cut rates now and risk fueling inflation again, or do they hold steady and risk pushing the economy into a harder slowdown? All of this is happening while real estate seems to be living in its own little bubble. Because even with all this economic uncertainty, home prices, yeah, they're still holding. In fact, many markets they're going up. In Arizona, especially around greater Phoenix area, Scottsdale, Goodyear, and even parts of Buckeye, we're still seeing homes sell quickly with median prices remaining strong. Some cities have even seen 3 to 5% year over year growth since January, according to Zillow Housing Market Update. Why? Inventory. There just aren't enough homes. The Wall Street Journal recently reported that the US is still short over 4.5 million housing units. That's a staggering number, and it's one of the reasons high interest rates haven't crashed the market. Most homeowners aren't listing because they're sitting on 3% mortgage rates from 2020 and 2021. So you've got high rates and low supply, which means prices stay sticky. Now, this is where things get even more complicated because when buyers expect rates to drop soon, they often rush into the market early, trying to get ahead of the crowd. That's part of what we've been seeing so far this year. Buyers aren't waiting for 5% rates, they're buying when the rates drop to 6.5% and planning to refinance later. Which, to be clear, can be a smart move if you can afford the monthly payment now and if you're realistic about your long term strategy. But it's also a sign that the psychology of the housing market has changed. People aren't expecting the Fed to come to the rescue them with cheap money. They're trying to make moves based on today's market, not the one they wish they had. And if you're a seller, especially here in Arizona, this is the window where pricing correctly really matters. Buyers are savvy right now. They're watching rate updates, price trends, and economic data, but they're also motivated. They're tired of waiting. So if you're listing at the right price with solid marketing and good staging, your home is still going to move. Now let's zero in on what all this means here in Greater Phoenix. If you're watching from out of state, maybe you're thinking Phoenix must be one of the markets that's starting to cool. After all, it saw massive growth during the pandemic. But here's the thing, despite the national slowdown, Arizona is still one of the most resilient housing markets in the country. According to Zillow's May 2025 market report, median home prices in Phoenix are sitting around 470,000, which is up roughly 3.5% year over year. In Scottsdale, the median sits closer to 765,000, with prices staying flat but strong. Meanwhile, more suburban and emerging areas like Goodyear, Buckeye, and Surprise have become the go-to zones for first-time buyers, offering newer construction and more square footage for the price. In Goodyear, median sales price is about 420,000 as of this month. In Buckeye, you're looking at closer to 395,000, and in Surprise, right around 410,000, according to the Zillow housing data of May 2025. These numbers matter because this is where buyer psychology really kicks in. People are looking at these areas and saying, I might not get sub 3% mortgage rates again, but I can still get into a brand new home in a growing community for under $450,000, and that feels like a win, especially when they compare it to what prices are doing in places like LA, Seattle, or Austin, where affordability is still a huge issue. And for sellers in those areas, you're in a strong position, but only if you know what buyers are thinking. Overpricing by even 10 to 15K can completely stall activity. Why? Because buyers are already stretching their budgets with rates near 7%. A house that looks overpriced doesn't just feel risky, it feels impossible. Now, if you're an investor, particularly long-term buy and hold investor, this is where Arizona continues to shine. Rental demand remains strong, especially for single-family homes in good school zones or with access to major employers. Cities like Tempe, Glendale, Mesa, or even the outskirts of Fountain Hills are still seeing stable rental income with relatively low vacancy rates. Cap rates might not look amazing on paper right now, especially if you're borrowing at higher interest rates. But what smart money is focusing on isn't cash flow in month one. It's long-term appreciation, tax advantages, and the ability to refinance into better cash flow once rates start to ease, even if that's late 2025 or 2026. In fact, Wells Fargo recently projected that home prices nationwide could rise another 3.5% annually over the next year, and that aligns closely with what we're seeing here in Arizona's high demand areas. All of that sourced by Investopedia. So here's what all this means. Whether or not the Fed cuts rates in the next few months, the housing market, especially here in Arizona, is still driven by a supply issue, population growth, and affordability migration from other states. And that's why, even with all the economic noise, homes are still selling. People still want to buy. The smart play right now is strategy. It's not trying to time the absolute bottom, it's knowing your local market, understanding your financing, and making moves based on reality, not headlines. Now that we've broken down the relationship between the Fed's actions and the housing market, let's talk about what you should actually do in the coming months. If you're a buyer, here's the reality. The market isn't crashing, and there's no magical discount waiting around the corner just because interest rates might drop a bit. As we've seen, inventory is still low and demand for homes in Arizona remains strong, especially in the areas that are priced for first-time home buyers. So, what should you do if you're a first time buyer or someone looking to make a move? It all comes down to timing and strategy. If you find a home that fits your needs, don't sit back waiting for the perfect rate to show up. It might be worth considering buying now to lock in a rate and refinance later down the road if and when rates drop. Also, don't forget about your down payment. With rates being what they are, it's more important than ever to make sure you have enough cushion to cover that initial cost. Whether you're putting down 3% or 20, those first few months with higher payment could be a stretch, but they'll be worth it in the long term if you're secure solid property in a high growth area and you have a long term buy and hold mindset. If you're a seller right now, the key is pricing your home correctly. Homes are moving fast in the right areas, but only if they're priced within a realistic range. Remember, buyers are already stretching themselves with high rates. The market is competitive, but not a free for all. If you've been thinking about listing your home in 2025, now's the time to get serious about staging, marketing, and setting competitive but realistic price. As for investors, this is still a strong market. While cash flow might not be as high as it was during the sub 3% rate days, long term appreciation is still happening. Even with inflation pressures and interest rates, Arizona's growth story is compelling. From Tempe's developments to Buckeye's expansion, the areas that are seeing steady demand are where you should focus. If you can hold onto a property for 5 to 10 years, the upside remains incredibly attractive. But the key to all of this, and this is critical, is staying informed. You need to be following the market closely, watching those Fed announcements, keeping an eye on inflation data, and understanding how all of this factors into your buying, selling, or investment strategy. So, what's the bottom line? The housing market isn't crashing. Even if rates don't drop dramatically this year, demand remains strong, supply is limited, and Arizona's growth is a big driver of long-term opportunity. Whether you're buying your first home, selling to upgrade, or investing for the future, now's the time to be strategic. And if you're feeling stuck or just want someone to bounce ideas off of, feel free to reach out to me. I work with first-time homebuyers, sellers, and investors in the Phoenix area to make sure they're not just reacting to headlines, but taking smart actions based on what's actually happening on the ground. If you found this video helpful, make sure to hit that like button, and if you haven't already, subscribe for more content on Arizona real estate. And hey, drop me a comment down below. What are your thoughts on the current housing market? Do you think the Fed will actually lower rates soon, or do you expect them to hold out longer? Thanks for watching, and I'll see you in the next video.